Hi, this is your boy. How's everything? Okay, today we will talk about IAS 20, which is a standard regarding government grants. First question is, why do we need the grants? So if government may help community or the economy by giving grants to the companies to motivate them to hire people, or in this way they will help reduce the unemployment. So it could be money, it could be in by an asset, if it is the asset, like it could be the asset anywhere, like if a company wants something. If I want something to produce iPhones, suppose, so it will help my country to grow. It will help me to get more employments. So I will ask the government to give me 60% or 70% of the total cost of the machinery, so I can bring that machinery in Pakistan and start working it, or start producing phones, or start producing cars whatsoever. So this is the way, like how do we, in this standard we will talk about what stages we can get the grant, or how to deal with grant, accounting treatment of the grant. The first is recognition criteria. First is, the company has to prove his credibility. Company has to prove the assurance, a reasonable assurance, that it will fulfill the government grants. It will fulfill the condition which is attached with the government grant. Company has reasonable assurance that it will fulfill conditions attached with the grant. So the thing is, if it has to they have to give the reasons that they are worthy for those grants. So, like, suppose if a company says, okay, if the government says, okay, I will give you 70% of the total cost, or say 60% of the total cost as a government grant. So I need to show them that I'm gonna keep it for my purpose, for my business purpose, for the production. So government, I will have to give the reasonable assurance to the government that I'm not gonna sell this product, I'm not gonna make a profit out of it, I'm gonna keep it. So the condition has to met. So the government, before they release the payment, they make sure that the company is true. So that's why they will tell the company that we will give you the grant, but make sure you don't sell it within 2 years. If you sell within 2 years, then the condition might be like, if you sell in first year, then you full grant has to be repaid. Or if you sell the machine after 2 years, or after first year, then 50% of the grant has to be repaid. So these condition, the company has to be assured that they're gonna meet these conditions. Secondly is, the grant will be received. The second condition attached to recognize as per IS 20. And the first condition is, the company have to have this reasonable assurance. The second condition is, they are pretty sure that they're gonna get the grant. They're gonna get the grant from the government. If these two conditions are met, it means you can book as a government grant as per standard says IS 20. Okay, the type of grant would be like I told you already. It could be income, it could be money, it could be like in cash, or it could be as an asset. Can be the government grant can be asset or machine or cash. It could be anything. It could be if company says, if the government says, okay, instead of giving you cash, I will give you the machine. Or if it might say that instead of machine, I will give you the cash and you buy the machine by yourself. These two conditions. And for this criteria, it has to met some conditions. The primary condition like would be like the buy to construct an asset, to buy or to construct an asset. If they have to complete, they have to meet that they have to have the assurance that they are going to buy or to construct an asset. They has to prove that why they need money, why the company needs the government grant. So either to buy something or to buy an asset or to construct an asset. These are the qualifying criterias. Or it could be like a number of employees or employed. Okay, it could be like government, by government we can ask government to give us a grant, so I can sponsor 60% of the salaries. So I will hire, instead of 100 I will hire 200 people. So if government is willing to give me 60% of their salaries, then I will hire, instead of one I will hire 200. This will ease the economy, this will boost the economy, and this will reduce the unemployment. And the like it has these conditions are should be met, like minimum number of years, if it is there, if it is there any minimum number of years, that government say that if you stay number of years of use. If government says that okay, I will give you the money to buy the asset, or I will give you the asset or a machine, but make sure you keep it for 2 years, for 5 years, like this. But the thing is, it's they are giving you cash. The government is willing to give you cash, or cash to buy an asset, or directly the asset. So you cannot book the government grant in as a profit and loss. Government grant is not your income, is not your profit or income. You cannot say that you have the government grant of 100,000, suppose 100k dollars, and this is not coming. This is not your profit. This is not your income. Why? Because this is not coming from your operations. This is not coming from your operations. So that's why we cannot book it as an equity, or we cannot book it as a profit, or like as a profit. It's not the income. You get my point, right? So it is, you cannot say that I have today, I got 100,000 from government, now it is mine. Now it is not yours, because this is not coming from your operations. Okay, let's do these. This is just the theory. Now let's do the example. Suppose company bought Okay, required financial extract, financial statement extract. Okay, okay, this is the question. The thing is, company bought a machine at year 0. I'll make a timeline. At 0, cost price is 100,000. I'm just taking 100 now. I'm gonna work at triple zeros. Okay, so we will consider this as 100. Okay, this is year 1, year 2, 0 to 1, 2, 3, and year 4. Okay, so company bought a asset, bought a machine for 100,000. Life is 4 years. So take a we can calculate the depreciation. 100 divided by 4 is equal, there is no scrap value, a straight line method. So we can say, let me see, it's 20, I think, I guess. $25. Okay. $25 as a depreciation. Okay, now we need to amortize the grant. When we have received the cash, well, we make an entry. We must have made an entry like, first we said cash received or bank received, and it says 20% of the cost. So 100,000 is the cost divided 20%. It means 20 or 20,000. So we must have received 20,000 as an from the government. So we must have passed the entry cash or bank debit to deferred income. We cannot post it into profit and loss because this is not your income. This is what I told you before. This is going to be your deferred income, and then what you're gonna do, deferred income to after first year we have to amortize. So this deferred income has to be amortized, and we will spread it over the years, over the life. Okay. So taking a picture of this question, then I'll move forward. So the cost is grant received was 20,000, 20% of the cost, and cost is 100,000. Just hang on. Hello. Yeah, I'm hungry. Okay. Okay, and then this grant has to be amortized over the time. So what will be, okay, I'll tell you in this now. So first year, after 1 year, this grant has to be amortized over 4 years. How we will amortize? How we will amortize? 20,000 divided by 4 years life. So it means every year we will take 5,000. Every year we will take 5,000 to profit and loss. This is being utilized in this. I'll come on this now. In this period we will say deferred income. We will reverse the deferred income by 5,000 and we will credit profit and loss 5,000. So when we amortized, we will pass the entry. What would be the double entry? Deferred income debit by 5,000 and to credit profit and loss 5,000. So this is the entry we will pass. So by the first year, end of first year, here the grant would be out of 20,000. Out of 20,000, 5,000 has already been 5,000 has already been amortized, and then the remaining is 15,000 at year first. Right? And the next year we will do the same. Deferred income debit 5,000 and credit profit and loss 5,000. And the year 2, at the point of year 2, the government grant would be, it was 15,000 minus 5,000. Now the government grant is of 10,000. This is the way we will take it into the profit and loss. Let's take in let's make a profit and loss statement. What things will go in profit and loss? X1. I'm making it for X. Let's make it X2. I'll tell you, there is a tricky point. So I'm X2. Okay. We will take depreciation in profit and loss. We will take depreciation amount. How much amount? Here, 25,000. Depreciation will go as 25,000. And amortization of government grant will go as 5,000. This is your income. That's why it will minus from profit and loss. It will be minus from the cost, or you can add as an income government grant. Now you can say this first year income. Okay, now we will make SOFP, statement of profit and loss. Machine will be displayed after depreciation or accumulated depreciation. So the machine was 100,000 minus 25,000 depreciation minus 25,000 depreciation for year 2. So by the end of year 2, the machine would be of 50,000 net book value. Machine cost. Okay, and then current liability and non-current liability. What things will go to current liability? See, come here now. At point year 2, this will be the remaining cost to be amortized. Out of this, 5,000 is finishing in next year, and out of this 5,000 will be in the later. So this 5,000 will be current liability, because this is gonna be finishes within a year, and this will be non-current liability because this will go to the next year. It is more than 12 months. So at the point first year, at this point, let's come on this point. At first year, the total cost was, the total amount to be amortized was 15,000. Out of 15,000, 5,000 is going to finish within 12 months. So out of 15,000 at year first, 5,000 will be current liability because this is going to finish within a year, and this 10,000 will be non-current liability. But here it is 5,000, and the end point 0 at year 4, end of year 4, the amortization value will be 0 because all 20,000 has been amortized. So we will say deferred income 5,000 and deferred income 5,000. This deferred income is finishing within next 12 months, and this is which is over 12 months. So let's do one more example. This will be the cost. Scrap value 200. Life is 20 years. Straight line. Grant received 40% on cost. Okay. Year end 31st March 2000x10. It cannot be x, I have to change it to 2010 and 2009. Okay, it is best if you take a picture of the question. Okay, company bought an asset for 1200 and the scrap value is 200. So take a depreciation first. Depreciation, how we will calculate depreciation? 1200 minus scrap value divided by number of years, 20. So you can say it will be of 50 per annum. Let's see, 1000 divided by 20, so 50 per annum. Okay, this is your depreciation. How we will amortize the cost? The government grant will be of 40% on the cost. The cost was 1200. Wait, let me see. The total cost is 1200. Okay, the total cost was 1200 multiplied by government grant, which will be a 40% of it. Means 40% is coming from the government and the rest you will pay from your pocket. So it means 480 will be your deferred income. Deferred income divided by 20 years life will be 24 per annum. It means every year we will take 24 from the deferred income to profit and loss every year. So let's make a timeline now. Here we buy the machine 09. We buy this machine on 09. Oh sorry, this is the July. Yeah, this is the point where we buy the machine. Okay, July Q. This is going to be December 09, and this is going to be 31st March 2010. Okay, and there is, if it is monthly basis, then you have to calculate the everything as per months. But if it is of yearly basis, you will calculate as per the years. Okay, this will go to profit and loss directly as a depreciation. This will also go to depreciation. This will also go to profit and loss as an income. Okay, now things which will go to a deferred income as in current liabilities and non-current liabilities. At this point, from here to here, how many? So we are working as an yearly basis. So this year, this is, we consider this 1 year now, not monthly basis. So it means 480 divided by 20 is mean 24. So when we have received the grant, we must have passed the entry that bank or cash received debit 480 and deferred income will be credit, and out of this deferred income we will take 24 in first year 1, then 24 to year 2, then 24 again in year 3, so on, so till year 20. Every year we will take 24 out of this. Now here at this point, so you have already deducted 480 minus 24, it means 456 already gone. In the whole year you have already used 24, so by end of the year you will be less with 456. So you will by end this year, I'll show you, by the whole year you have already used 24. So this you have already used 480 minus 24 will be 456. This is your 456. So the whole year you have used this. So if we will take 24 out of this, so you will do, what you're gonna do, deferred income debit by 24 and to profit and loss 24. You have realized 24 first year deferred income. You have received 456 at the closing balance. Now you will see out of this 24 will be utilized, will be realized, or will be amortized within 12 months. So this will be your current liability, and 456 minus 24 is equal to 432. This will be this is because it is more than 12 months. This liability is of more than 12 months, so this will be your non-current liability. So let's start posting them. Profit and loss account. What will go to profit and loss account? Depreciation is here. There you go. This is your depreciation 50, and then amortize deferred income, or amortization of deferred income, or amortization of grant. This 24 as an income. This is your profit and loss. Now make an SOFP. How we will make SOFP? First, machine NBV, net book value. The thing is, you will have machine is of, the total machine cost was 1200 minus 50 is your depreciation. Here you can see 50 is your depreciation. So 1200 minus 50 is equal to 1950 is your NBV. Current liability will be of this, as this is finishing within 12 months. So current deferred income 24, and non-current liability deferred income of 400, and we have calculated here. So you can see this is over 12 months. So 432 as an deferred income, non-current liability. So this is a total structure. say I put the same question. If in case we have to return the grant back, let's do this example. Repayment of grant. There is one method in your book. It is not important, but it is in the book. So the thing is, this is the way we calculated deferred income, right? But in the book there is another method. If you have 100,000 cost of an asset, okay, and you have received 20,000 as a government grant. One method is deferred income, which I have studied. The second is take a net of this minus this amount and consider the cost was 80,000. We will consider as a we have bought this asset for 80,000 and depreciate it over 80,000. Then we will not have to calculate the deferred income. But this is not practical, but it is in the book. That's why I just told you. Okay, now let's discuss this repayment of the government grant. In what cases we will have to give it back? So if you say it is one of the condition of the government that we are giving you the grant for if you're gonna keep that asset for 2 years, but we sold that asset in 1 year, then the full repayment has to be repaid. The whole the whole grant has to be repaid. In this case, how we will consider this? Let's do an example. Let's take it here. Okay, let's do it. Question is machine cost 10,000, life 2 years, government grant 40% of cost. It means 40% on this cost. Okay, and I will tell you we will sell this repayment, full repayment, if sold within 2 years. Okay, so the government grant should be, how we will calculate, 100,000 multiplied by 40%. It means we have 4,000, 100,000. Oh, okay, it's 10,000 cost, 10,000, not 100,000. So it means 4,000 we have as a government grant, 4,000. So we will amortize this 4,000 in 2 years. It means every year we will take 2,000 out of it. Okay, let's make this 1st July x8. Say 31st December x8, and then full year 31st December x9. Okay, so we suppose we bought this machine on we bought this machine on x8. So when we receive this grant, we must have passed the entry bank or cash debit, how much, 4,000, and deferred income 4,000 credit. Okay, so we cannot take it into profit and loss, we have to amortize. So we have to amortize. So these 6 months we have used it, so we will pass entry deferred income debit and credit profit and loss. 6 months is of, if it is of 1 year, this is for 2 years, 4000 is for 2 years, multiplied by this is for 2 years. So every month we will take, how much we will take? To 2000. Out of 2000, 6 months is equal to 1000. So it means this 6 months we will take profit and loss to 1000 only. So in this point, at this point we will have 3000, as because out of 4000 we have already amortized 1000, means remaining is 3000. Out of 3000, this 2000 is finishing it within 12 months and 1000 is finishing over 12 months. Okay, but we sold this asset before 2 years, so we have to pay the full we have to repay the full grant. So in this case, how we will calculate, we will see the full grant is of 4000. So what I will do is I will take a 4000 out of my pocket and I will give it to the government. So the credit entry bank, I will pay to 4000, I will pay this to government. Out of this, how much we have used already? So we have used 1000, and in the here as well we're gonna use 2000 deferred income, and remaining is the deferred income. Remaining will be, this will be deferred income non-current liability after x9. So we will have to repaid at this point, repaid grant. So we will have to repay the full grant on this point. So it means how we will deal with this. So we will pass an entry, we have to pay the full grant. It means we will have to pay full cash. So the cash or bank credit 4000, we are paying 4000, and the total grant deferred income, total grant was 1000. So it means 3000 we have to pay from my pocket. So this is our loss. So this is the way we will repay the full grant. In this way we will pay the full grant. So if there is no condition, if you have done something good in past and then government is willing you to give you the grant, then in that case you can take it, the full grant, into profit and loss. And the second one is grant in the form of asset. Sometime I told you in beginning, the government is not giving you cash, they give you the cash, they give you the asset instead. So take the fair value of that asset as a government grant. Take fair value of that asset as government grant. So if the government is giving you the asset, they buy the asset for you and give it to you, then in that case how we will consider what is the government grant. So instead of cash they give you the asset, then take a fair value. If the fair value is of 100,000, so take this as a government grant. Alright, this is for the day. So please do subscribe my channel and keep watching my videos. See ya, thank you, bye.